Okay, we're back. This is part 2 of monetary policy, and in chapters 16.1 and 16.2 that you were supposed to read. We are now on the back side of the information that you received, and we are now looking at the tools that the Fed uses to manipulate the money supply and affect the cost and availability of credit. The first one is the reserve requirement. Now, if you remember, we actually did some math on this and practiced this, where the reserve requirement is the percentage that banks have to keep in the vaults. Now, they may not literally keep it in the vaults, but it's at least electronically on paper the amount that they're supposed to have in reserve for depositors and people that want to withdraw. So again, like I said, we have to manipulate these to see what's going to happen. So here's an example of a test question. If the Federal Reserve chooses to raise the reserve requirement, let's say from 10 to 12%, what would happen to the money supply? Would there be a contraction or an expansion? Well, there would be a contraction because that banks would have to hold back more money in the vaults, so to speak, and that means less money to loan out to consumers and businesses. So that's an example of how the Fed might manipulate the money supply. Secondly, let's see if you can move here my picture. You have open market operations. The Fed can affect the money supply by buying and selling government securities in open market operations. Now, I'm going to suggest in a little bit for you to do the unit review questions to get ready for this test, and you will get to practice these type of manipulation of these tools. But basically, a government security is a treasury bill, treasury bond, like we talked about earlier. So let's think of some scenarios. Here we go. Let's say the government, the United States federal government, wants to sell more government bonds or securities. If they're offering more of these for sale, theoretically, people are saying, I am going to purchase these bonds and I'm willing to part with my money. And in other words, I'm not going to spend it right now. So that would cause a contraction of the money supply because people are giving up their money to buy bonds. So if the government chooses to buy them back, then people that are willing to sell them to the government, or the government buying them back, means the government now is paying cash to them, and thus people want the money and they're apparently getting ready to spend that money, creating more money in circulation, thus expanding the money supply. Now, this is usually very confusing for students, and it's on this current test coming up and on the final. So again, I would suggest you practice this on the review portion on Moodle. Now, the third example is when the Feds change the discount rate. I don't know where my picture went. Hopefully it'll come back. But anyway, the Feds are changing the discount rate. If you remember, discount window, same thing. Let's say they charge, if you remember, it was 0.75%. Let's say they raise it to 1%, the discount rate, the rate that member banks are charged to borrow money from the Fed. That would mean member banks would borrow less money if that interest rate's higher, meaning less money than would be circulating, meaning a contraction of the money supply. So in this case, in that scenario, you would have that, and then let's say they lower the discount rate in theory, then what you would have is an expansion of the money supply because theoretically banks would be more willing to borrow more money. Now the next one is changing margin requirements. Now, I don't know if you remember in an earlier lecture, but we talked about in the 20s, you could borrow up to 90% of the value of a stock. So that meant if $100 a share stock, you would only have to pay $10 for. The margin was 10% that you only had to pay. Theoretically then, that means people would be more willing to spend money in the market, and thus there would be an expansion of the money supply. Well, if you, let's say, like it is right here, currently it's around 50%, and there's a minimum $2,000 investment. So theoretically, if we raise that margin requirement to 50%, that means people are less willing to borrow as much money to invest in the market. So that would cause a contraction of the money supply. Next, this one's really interesting. This is called moral suasion. Obviously, the word suasion makes you think of the word, I would assume, persuasion, and you'd be right. This tactic is used by the Federal Reserve Board. Remember the Federal Reserve Board, the 7-member board appointed by the president, and for 14-year terms, and they're supposedly nonpartisan. Well, here's an article that I have hung up and referred to. This is about our little diminutive friend, Janet Yellen, who's the chairman of the Fed. And I don't know if you can pause the video and look at the highlighted parts, but basically this is called Fed speak. And in this article, it's referring to Janet Yellen basically just talking. I know this sounds weird, but she's just basically saying something that might happen, like a vague threat. It's not even necessarily policy yet. It's just her opening her mouth. And you would not believe how the markets can go crazy if the Fed, just Janet Yellen saying something like this. She may say, the Federal Reserve is considering raising the Fed funds rate to 2%. Now, she said considering, didn't say she was going to. But just saying they're considering can cause the stock markets to go crazy. For instance, if she said she's going to raise it 2%, what do you think would happen in the markets? Well, if you think about it, there's probably going to be a major sell-off. And that means the value of the stocks would probably go down. Not a good thing. So moral suasion is a very powerful tool, even though it's not necessarily policy. Now, this last one is a little bit tricky. But the government gets involved sometimes by pressuring banks to loan out money for certain things. Now, I have a little bit of a diagram for you to look at here, or information. Selective credit control is this policy where the government influences the ability of people to buy certain things. We've done a lot of things historically, but I thought two that you might have heard of before. Let's say the government wants the automobile industry to have a boost. So they may start a program like Cash for Clunkers. Some of you have heard this before. This happened about, maybe 4 or 5 years ago, where the government was allowing people to turn in cars that they considered old just because they might not have met a standard that they're trying to set. For instance, they said, if you turn in your car and purchase a car that gets 30 miles to the gallon, we will give you, I can't remember, I thought it was like an $8,000 credit on the purchase of that car. Well, obviously, where does that credit money come from? Well, it comes from your tax dollars. And guess what they did to this car that was perfectly good? And let's say it was a Lincoln Navigator. It might have only been a year old, but it didn't get 30 miles a gallon. They called that a clunker. And you turn it in, and guess what the federal government told the dealers they had to do with it? Well, they had to crush it, destroy it. They weren't allowed to resell it. Now think about that. People were getting rid of perfectly good cars and trying to buy something that theoretically was better for the environment because it was 30 miles to the gallon. Well, what did they just do? They wasted resources to have people buy cars they didn't necessarily want and use tax dollars to do it. Now, what's interesting is these auto dealers were supposed to get money to give credit to people of $8,000 for these cars they purchased. Well, guess what happened? A lot of auto dealers never got paid the discount that they were giving their customers. So this money literally never appeared. Put it this way, the program was a total failure. People buy cars because they like cars. They want certain types of cars. So the government was trying to influence what people would do to spend their money. Well, another one, if you ever heard of Federal Housing Authority, FHA loans, my guess is if you ask your parents, they may have received money to buy their first house in an FHA loan. The government is putting money in the system or encouraging banks to make loans for first-time homeowners, maybe at a little bit lower rate, to get people to buy homes, even maybe if they can't afford it. Well, anyway, these programs, again, the goal is to promote certain industries to get you to spend money. And the government wants to encourage, obviously, the either the slowing down of money or in other words, the contraction or expansion. All right, now the last thing we need to cover are the major regulatory responsibilities of the Fed. This is our third learning target, and we can go through these pretty quickly, but the first responsibility is maintaining the money supply, and that's through the printing of money, like currency, like I showed you earlier. That's called the Bureau of Engraving and Printing, BEP. That's in Washington, D.C. And they mint coins, the U.S. Mint. And I believe that is in Denver and Philadelphia. I believe those are two mints. And maybe Washington has one. Not quite sure. But anyway, they print money when it's needed, and they actually destroy money when it's needed. For instance, if you look at this little bag, this was obtained on a tour of the Federal District Bank of Chicago. And one of their responsibilities is to shred old money. And this is a bag of old money. And interesting enough, if you look at this little bag, this has about $364 in this little bag. You get this on the tour when you are done. So it's kind of interesting. But anyway, I can't remember how many millions of dollars they burn on a daily basis that's worn out or whatever, and then they replace. So that's the first responsibility. Second, they maintain the payment system. Now, let me move my picture here so you can see a little bit better. The payment system is like, for instance, let's say you do electronic transfer on your phone or your computer. They maintain that. A check clearinghouse. They have locations that take the checks that you have, and I'll show you an example. Well, I better not, now I think about it, because my numbers would be on there, and that would be bad, because you would have access to that. But anyway, there's a little number on the bottom left of your check that you've probably seen before, and that number then is viewed electronically, and it can clear what's in your account, take out the money that's in your account, or if it's a deposit, it will deposit a certain amount in your account. And of course, we already talked about online banking, electronic transfers, that they maintain that also. Now, third thing, they regulate and supervise member banks. They monitor, and not even member banks, I guess banks in general sometimes. They monitor, inspect, and examine for things like banks, are they complying with the laws? What if there is a bank from Iraq in the United States? Now, obviously, in Fort Wayne, we don't have international banks here. But in larger cities, you may see that a little bit more. And they would oversee international banking operations. They would examine state banks' reserves, making sure that the amount of money they say they have is in their vault is actually there, like Garrett State Bank, Farmers and Merchants State Bank. And they examine holding companies, which you don't have to really know about that. Next, a third thing they do, they prepare consumer legislation. This is one of the famous laws that was passed. It's called Regulation Z, and its goal was to tell you what you are borrowing and what's happening when you're borrowing. You have to be told by law what percentage you are charged and what your monthly payment will be. So that's another thing. And lastly, they act as the government's bank. They auction U.S. Treasury bills and bonds. They maintain the Treasury deposits. For instance, when they have to write you a check, a tax refund, you get a check from the U.S. Treasury. They issue checks for the federal government. Now, with all this being said, I would heavily encourage you to do a review for the test. I would go to the Moodle page, and it will be available at some point, and do the money and the role of financial institutions review. You can click on that. Also, you can click on the Jeopardy to do a review. Thank you again, and happy studying.